Welcome to this week's Money and Markets Squawk Call, where we'll go around the horn with all of our editors to give you their insights on the happenings in the markets for this week and beyond. Today is Tuesday, April 22nd, and joining us on the call today are Mike Larson, Doug Davenport, Don Lusick, and Mandeep Rai. Obviously, a lot of topics in the market lately. Right now, of course, we're in the middle of first quarter earnings reporting season. That seems to be what the talking heads, anyway, on CNBC are wasting most of their hot air talking about. So far, the earnings are off to kind of a soft start. Of the, I guess, 82 companies, according to facts, that have reported in the S&P 500 so far, and about two-thirds of them have reported earnings ahead of estimates, and about half, roughly, have beaten their sales estimates. But I guess the interesting things to me is the earnings growth this quarter, or lack of it. The forecasts actually call for a decline of about 1.3% for first quarter earnings. And if that's the case, then this will be the first time in a little over 2 years that we've seen, or right around 2 years, we've seen a year-over-year decline in quarterly earnings for the S&P 500. Sales are expected to be up a little bit better than we've seen lately, about 2.5%, I think, is the estimate, so beating sales. But I guess we could talk about that this morning, as well as any other topics on your mind that you're watching closely. And Mike Larson, why don't we go ahead and get started with you?
Sure, thanks. I think we're in a period where it looks like both the U.S. dollar and interest rates may finally be bottoming out here. We've seen kind of a sideways move in things like the 10-year yield. Again, that I kind of grown tired of saying it, but we've been stuck in this 2.6 to 2.8 range on the Treasury, and the dollar has been under relatively steady downward pressure. But I'm looking at the euro kind of apparently looking like it might be topping out here, and things like the TLT having exhaustive moves to the upside, maybe be topping out as well. So one of the things that I think will be very intriguing to see here is if we get an acceleration in U.S. economic data, which is what I'm expecting. Some of the numbers in terms of retail sales, industrial production are strong again. Some of the jobless claims are looking pretty good. So many of these things kind of point to a spring rebound, spring thaw, or even potentially acceleration in the economy. I think that could lead to some topping action in bond futures, bottoming action in the U.S. dollar, topping action in the euro, and so on. So I'm very closely watching that development in interest rates. Meanwhile, in some of the sectors that I've highlighted in things like safe money as being, powerful bull market trends, secular bull market trends are continuing. We've got great numbers out of United Technologies and aerospace. Many of those aerospace names in the upgrade cycle have done very well. One of my single biggest positions in SMR is GlaxoSmithKline, and that's hitting pay dirt this morning. The stock's up about 5% on news of some mega, $20, $30 billion transactions. When you add them all up in the pharmaceutical space, a three-way kind of deal between Novartis, Glaxo, and Lilly. Which just goes to show if you focus on some of the select sector bull markets, private bull markets, whatever you want to call it, you can really kind of almost triple or quadruple dip. You can get generous dividend yields, shareholder-friendly actions, massive waves of deal making, and so on. And that's where you can really make a killing. But in a relatively safe fashion, because these stocks are all highly rated, they have very nice dividend yields, and so on. So, focusing on those kinds of names has paid off in SMR, and I'm going to keep at it. And again, on the interest rate side of things, I'm very closely watching the action here because I think we might be getting a reversal of some of these trends that have been going on for the last couple of months.
It's interesting you mentioned interest rates because you're right. TLT has had quite a run this year. I think that ETF is up about a little over 8% year to date. It's one of the strongest, most consistent trends I think we've seen in the first 3 months of the year. What gives you the impression that we're going to see a reversal here?
Because even as TLT has been up, in terms of price, it looks exhausting to me. It looks like it's exhausted on the charts. Moreover, long-dated Eurodollar futures are actually making a series of lower highs. I got short the September 2016 contract, for example. If you put TLT against that contract, you'll see that's made a series of 3 lower highs since December, and it's kind of looking like it's a breakdown pattern setting up. Even as the euro looks like it's topping, and the euro's about to do QE while the U.S. is getting out of the business. and I think the U.S. economic data is picking up. So, and I would also note that looking at on a yield basis, some of the shorter-term yields, like a 5-year Treasury yield, has made a series of kind of a recent higher high and a series of higher lows since November, and that looks like a breakout pattern to me, like it might eclipse 1.9% sometime in the next couple of weeks. So I think TLT has worked, but it's a loser bet going forward, given that I think the economics argue for it. We had a pretty big bearish technical reversal in TLT on the daily charts yesterday, or excuse me, 2 days ago. And I think that there's a lot of sort of exhaustion patterns that I'm identifying that look like we're due for a change.
Okay, interesting. Definitely keep an eye on that. Doug Davenport, how about you? I know that you've been kind of bullish on the bond market among other markets here recently. What's your take on markets overall?
Well, I'm very happy with TLT so far this year. I've been long that all year, so I'm very, very happy to have that. And I can't tell you where it'll be a week from now. I did have a bearish engulfing pattern on Friday on TLT, and that's not a good thing if you're long TLT, but a lot of it's going to depend on disinflation and inflation, what we think will happen worldwide, what kind of growth are we going to get in the U.S. Does the Fed decide to pull back on tapering if it sees slow growth? Whatever, I don't know where it is. I just let the chart tell me. But on stocks, if I look back to even my weekly commentary I sent out that showed that the S&P has held the 20-bar week moving average 7 times since 2012, so that still tells me we're in a bullish trend in the S&P right now, because it's only about 1.5% off its all-time high. So the momentum and trending indicators still bullishly aligned. We have a prior swing high of 1872 that goes back to April 10th. Market closed at 1871 yesterday, so it would be nice to be able to take that prior high back out. We'll probably do that today. But, however, a small pullback would certainly be welcome here, because if you can get a small pullback, there is a potential inverse bullish head and shoulders pattern that is forming. And if you could get the S&P to pull back, I think that would actually be good, because that would, I think, stand to catapult the S&P even higher into May, and I don't know where it'll go after that. But I think you could easily see new highs taken out here pretty soon. Might even get into the low 1900s before maybe a summer pullback, if we even get one. But if you look at the German market, it's up 1.5% today. Transports still look well. Russell is still in this bullish channel that we've had since November of 2012. Gold still in a bear market. If you look on any daily, weekly, monthly charts, still bearish. In fact, on the monthly chart, the last MACD crossover was in January of 2012. I showed it on a chart this week, and that was a bearish crossover. That's a long time. That's almost 2 years plus on a monthly chart that gold is bearish. I don't know if anyone saw this too. This came out in the Wall Street Journal that the Gallup organization did a poll on what would be the best investment choices, and they broke it down by income. And it said for anyone who made above $75,000 in their survey, real estate was the #1 choice of those individuals, followed by ABC, whatever. I didn't look past the first choice. But for the people whose incomes were below $30,000, the #1 investment choice was gold, which I thought was kind of interesting. The wealthy said no, they like real estate. The poor people said we like gold. Crude oil's got a bear wedge forming. It's down about 1% this morning and before the market opens. So crude oil's been in a bear wedge here for about 2 weeks. I just hope it'll go ahead and pull back. I think there's a lot of indecision by institutional traders, because 5 of the last 6 trading days in crude oil we've had doji candlesticks, which are by definition indecision by traders. Bonds still bullish there until the trend tells me it's not. Energy, boy, that's been a great place. I've got energy and energy services and basic materials, and those are 2 very strong areas of the S&P sectors for the last month. The energy sector's up about 9% for the last 30 days. And so we see Halliburton, you see Schlumberger, you see all of those stocks doing quite well. Oil, energy service, I'm very happy there. Emerging markets, still bullish in that category too. And I guess last but not least, we have a big QE buy program tomorrow.
So that should help goose the market a little bit, right?
We hope so. I'm not sure how much the size of it is, but it's the big one tomorrow. The
New York Fed's at work. putting your tax dollars to work.
That's correct. unfortunately.
Doug, I know you follow the technical side of the market pretty closely. Does it worry you at all for the longer term? You know, maybe as we head into the summer months, that the S&P, a chart of the S&P on a weekly basis, we've seen, you know, sort of a breakdown or a negative divergence in both relative strength as well as MACD, you know, moving average convergence since really the end of December 2013 or January of this year. And, you know, it looks like it's signaling that we're going to trend lower here. Also, we've seen breadth get pretty weak for the market.
Yes, the negative divergence certainly is a concern for anyone who's a chartist. That could easily be the sell in May and go away pre-signal that we're getting right now.
Interesting. We'll have to keep an eye on that. All right, let's move on to Don Lusick. Don, we started the call talking a little bit about first quarter earnings season and how this will be the first negative year-over-year earnings, I guess, loss in about 2 years if the forecast pan out for minus 1.3% growth. What are you seeing so far in the earnings results?
So far, so good. I mean, I think that you pointed out that it's not 2/3. It's more like low 60s% of companies beating estimates so far. You know, it's funny when you have a shortened week right here at the beginning, like we had last week. But now we'll get the onslaught over the next 3 weeks. We'll get, you know, thousands of earnings reports. So the bulk of it is yet to come. So they have not been bad. They have not been terrible. What I've seen so far, though, you take like a SanDisk, all right? Flash memory, everybody knows it's not going to be that great this year and everything, and boom, they come out with a decent earnings report and, bless 2014 estimates, and the stock just takes off. You know, it's that kind of thing where just recently we had this pullback in tech and biotech, and this is the area where I think you wanna be adding exposure. When you see snapback action like that, it seems so like you guys use this term oversold, and also like from fundamental perspective maybe oversold. It clouds the analysis a little bit when they jump that much on an earnings beat. I think that, so far so good in earnings season. I think that, again, the bulk of it's ahead of us. I think that it's not going to be that tough for companies to meet or beat estimates, as you said. I mean, we're expecting it to be down 1.5% or 1.2%. For the quarter year over year. So it's not going to be that tall an order, I think, for companies to beat it. I think that, but we've not really seen companies really punished if they didn't have the ebullience, if they didn't have the beat so far. So again, the early returns suggest that we have a decent earnings season shaping up. I think that the guys are also, though, they're smart to be watching the yield curve and watching interest rates, because I don't know. I think this is like sort of the Fed's game to lose with its removal of accommodation, and maybe we'll see a test of that. We'll see some sort of weakness in economic numbers or something, where where the Fed, newly chaired by Janet Yellen, is tested here going into the summer. That's I think that the probability of something like that happening is rising here, because I mean, I don't see too much unexpected information coming in that's overly bullish. What I'm seeing is sort of a continuation of trend. Things seem to be. I think it's a little too early to call to call victory for the earnings season. We'll see as it unfolds. I'm looking to, though, and I think Mike mentioned it earlier, United Technologies. Great report today. Also mentions he also mentioned healthcare in the drug business. I think that that's a pretty interesting place to be looking at all of a sudden. This Glaxo, of course, there was this bid for Allergan out this morning. There are things going on. Maybe you'll see a consolidation. Maybe we will see finally some sort of move towards a big three in pharmaceuticals worldwide. Who knows? Who knows? I think that game is in very early innings. I think earnings season's in early innings, so not too much to say definitively yet. But ask me again next week.
You'll be watching those results closely, as I know you always do.
I watch them all, Mike. I mean, as many as I can get my hands on, right? And luckily I have the Weiss ratings that the model sucks in all of these data points every day. Anything that's available to be used to improve the algorithms is used. So, yeah, I mean, I haven't seen a lot. Like in the past couple of weeks, I've been pretty incredulous about market movement, and the market movement does have an impact in the short term over ratings results. So, in the absence of hard data like the earnings reports, it's really tough to make a call on that. What I expect to see, though, I expect to see that the earnings trends that we've seen should translate into ratings trends, and I think you're going to see some firming up of Weiss ratings and a firming up of investor confidence. We'll probably, I think that a number of people have suggested that we'll probably get tested in the summer. And I'm speculating that it's going to be Fed-related, but I think that that's a pretty good bet.
Okay. Thanks for your input. Very much appreciated. Mandeep, let's turn to you now. Kind of wrap us up today.
Hey, everyone. So, yeah, a lot of what I was going to talk about has already been talked about. In terms of earnings season, I'm looking at the growth numbers. We saw that revisions were being placed towards the downside in terms of expectations for sales and earnings. So the surprise indicator, even though we are getting a fair amount of surprises, is not exactly where I'd want to head to as much as the absolute growth. And I think you said that we were looking for negative 1.3% growth. But with 20% of companies, 100 or so of the 500 reported, we are seeing sales growth around 1.5% and earnings growth of 4%. Better than expected. However, it still shows the same adage of lack of revenue growth and beating expectations and growing the bottom line based on cost cutting, financial engineering, share buybacks, etc. So positive, mixed. And not exactly what we want to see. We're looking for expenditure. We want to see companies guide higher for the future based on spending more money now on growing up businesses, adding multiple revenue lines, things of that effect. That's something we're kind of keying in on. And our strategy for our portfolio is kind of looking to purchase stocks that have proven themselves. Beat earnings, beat expectations, are growing, guiding higher for the year, confirming or upping guidance, and that basically prompts analysts to go back to their models, put in higher numbers, and so now you have a beat growth momentum. So you have a jump in the stock price, and you have value because now you have higher earnings expectations, and so we're buying quality plays. As much as possible within the sub $10 universe that we're in, and there's not a lot of consistent players in that, so it's like a walking on eggshells kind of a universe, but that's what we're trying to do here.
Okay, sounds great. Well, that wraps things up here for this week's Squawk Call. Great insights and investment ideas, guys. Much appreciated. Be sure to tune in again next week, and until then, I'm Mike Bernick for Money and Markets. Good investing.